the trade that I put on is IBIT. I put it on a January 16th position for, let me change this to BITO, looking for Bitcoin to continue going lower. BITO, too cheap. BTCUSD, for me, IBIT was the best choice. So I placed this trade already. This is a put debit spread, right? PDS, Bitcoin down, and it's for January. So if you guys have, clearly many of you have not yet gotten to the 10 musts that matter, or the 10 musts to master, I think is what it says, which is in the Nugget Farm. And one of the things that I teach you how to do is how to hedge. I also teach you how to get a better price by using credit spreads and lowering your costs for options, because the options market is price to lose, price to kill you. So you have to learn how to get a better price and get an advantage. I teach you how to do that. And there's also a lesson on how to hedge. If you're placing a trade like this in a volatile market for January, then one of the things you could do if you needed to is you could do weekly hedge, little weekly insurance in case Bitcoin pops this week. What I'm not saying, Lion of Judah, is that you buy BITO if Bitcoin goes up. What I'm saying is I'm shorting Bitcoin now for January, but I'm buying some insurance. So it's a weekly piece of insurance. So I buy a super cheap little 19-cent, $13 call for this Friday, just in case Bitcoin pops. If it pops, and let's just say I could make, remember, this cost me $1.25, the IBIT, right? If Bitcoin pops, I'm not going to get out of my IBIT trade. Now, if price gets over 90,000, then I'll probably take the trade off. That means Bitcoin is finding buyers, the market is flipping. It might mean something more significant. Maybe 92,000, I'll get out of the trade. But if we get a little bit of a pop in Bitcoin, and this 19 cents all of a sudden is worth, say, 30 bucks or more, I could get maybe $20, $30 of profit from it, then I'll close the trade, and that $30 profit means that my overall IBIT trade is now a 95-cent cost basis. I was able to lower the cost by utilizing this hedge. If price continues to move lower and the hedge isn't worth nothing, then by Thursday, maybe Friday morning, if it's worth 5-10 cents, maybe I'll get 10 cents back or 5 cents back, close the trade, be done with it, and go to the next week. Or maybe I lose the whole 19. If I lose the whole 19, okay, that's fine. I'm in the trade for 144. This plus this. And then next week, I can do it again. The following week, I can do it again. I may not be able to use BITO. I might have to use BT or some other weekly proxy on Bitcoin if I choose to do that. If price is continuing to go lower and lower, then I'm not going to hedge. If it flattens out and starts to get a little oversold bounce, then I'll consider putting on a weekly hedge. So if your main trade, just to reiterate, if your main trade is monthly expiration and you need a hedge, you hedge weekly. So if you did like NVIDIA or something, or QQQ or tech or something for January, then what you could do is for next week's expiration, which is what, the 27th, I think, or the 20, what is it? The 26th next week, you could put on a hedge here on like SQQQ, just in case next week the markets rise up like that. You get a little Santa rally, you make money on the hedge, and then after the first, it goes back to what you initially thought. You're right, but you were able to make money here, take that hedge money, and that lowers your costs. Okay? Everybody clear?
Thanks for watching. Hope you enjoyed this video from Trade With Me Now. Make sure to go ahead and like this video and subscribe to our channel so you make sure that you catch our next video right when it's released. Also, if you have a question or comment, please leave that in the comment section below. And of course, if you want to learn more about Trade With Me Now or join our community of profitable traders, go to tradewithmenow.com. There's also a link in the description below.